Happy New Year, everyone. Mike over at Charts Don't Lie. I wanted to put together a video for you guys that would take a look at where I think the market is going here in the beginning of 2015. Now, I'm not going to make any wild predictions of where the S&P is going to be or the Dow is going to be at the end of the year. There are a lot of people that do that at the end of the year and the beginning of every single year, and it's really just a shot in the dark. The way in which I'm successful is continuing to pay attention to what the charts are telling me, and they do change as time goes on. So I don't like to marry positions or make really long-term price predictions because more oftentimes than not, they don't pan out. That being said, let's take a look at what happened in 2014 and how that's going to have an impact going into the beginning of 2015. Now, if you like to trade the micro caps and the small caps, 2014 was a really bad year for you. None of the gains really held any of the stocks. It was the year of the pop and drops. And as you can see, when we have this chart of the IWC up on a weekly basis, 2014 really was just a giant bull flag. And if we take a look at the Russell, you'll see the same thing. And if I zoom out to a monthly basis, you get an even better picture of it. We've been in a prolonged uptrend, and we had a year-long bull flag, and we did break out here in December. If the Russell and the IWC can stay above those lines in 2015, it should be a change of character inside of the small caps as money continues to flow into them and should provide a number of swing trading opportunities. Now, the big story from 2014 was, of course, the U.S. dollar and commodities in general. Now, in 2014, I made a prediction that the U.S. dollar was going to go to the 91 area. I wanted to show you how it got there as we just hit it the other day. This was the trading range that we were in for most of 2014. Then we had this nice setup here. We had our breakout. We ran higher for a while, and then we set up in another bull flag. Now, the way in which I made the $91 price prediction is through the measured move of taking the breakout point to the high of that move, duplicating this and moving it right over to the next breakout point, which gave me a target of approximately 91. Now, the big question is, now that we've hit that, where do we go from here? Well, the US dollar, if we look at it on a monthly basis, has been out of its upper Bollinger Band now for 5 straight months. We had set up in this nice trading pattern over the course of a few years, and we have a clean breakout. Now, what we have is a lot of bullish bets on the U.S. dollar. We're out of the upper Bollinger Band, which is designed to keep price inside of it 95% of the time. It's been out of it for 5 straight months, and we've got resistance from 2004 and 2005 right at that $92 area. What I expect to see in the beginning of 2015 is for the U.S. dollar to pull back. Now, I'm not saying break down, but most breakouts do back test. So I would expect to see the U.S. dollar kind of get to that $92 area and pull back. If that happens, we're going to see a lot of interesting setups inside of the commodities. So crude oil, as we all know, has been in a free fall for the second half of this year. The low from 2008 is all the way back in the 30s. Now we're at 52. I would expect to see a 40 handle print in the beginning of this year. And if the U.S. dollar does make its pullback, we could see a setup like this where we get a pullback into the 40s, and then we have our tradable bounce higher in crude. Natural gas is a very similar setup where we have broken down. And if we draw a low from the 1998 lows through the 2011 lows, we get a target of around that $2 area for where natural gas can fall. Now, most people continue to ask, well, natural gas is bullish during the winter, right? Well, historically, that's not necessarily the case. And when we look at natural gas on a daily basis, you can see we've just set up in a bear flag. We broke down. We set up in another bear flag. There may be more downside to natural gas. Now, you certainly can take your shots if we do get this low tested, that 281 area. You certainly could take a shot, but you would not want to be owning natural gas or crude at new lows. Now, the one area that I really like from a commodity perspective is gold. The reason being, we have this bullish falling wedge that is set up over the last few years. We tried to break out above the downtrend line a few times this year, only to be rejected. Now, from a risk-reward perspective, from where we are right now versus the low of the year at 1130, one is only a 5% downside, where I think the upside potential is definitely back to that 1350 area, which would be 15% to the upside. So that's our 3-to-1 risk reward. The other reason that I really like gold, if you remember the EWZ play that I showed you on a daily basis a few months ago. I really like to buy the lower Bollinger Band break and the back test. This test right here is the best low risk entry out there. That's what we have on gold, not on a daily chart, but on a monthly chart. We had the breakout of the lower Bollinger Band, and it took about 1.5 years, but we had our test at that 1130 area. I think that that is going to be the low for a while here. Now, of course, if that does break, my mind will change, but where we are right now, we have a very good risk reward, 5% downside, 15% to the upside. If you look at the actual individual miners themselves, what you can see right here, we had our downtrend. When we broke it in the beginning of 2014, we ran higher for 3 months. It was a very large percentage gain. Then we had another downtrend that set up from April to June. When we broke out above that, we ran higher. And on Friday's close, we broke out above the downtrend from September. So I think that the miners are giving us a very actionable trade here in the beginning of this year. Now, the other area that I wanted to point out that's very dollar sensitive is the emerging markets. We do have this type of trading range that is set up right here, and we are very close to where you wouldn't want to own it underneath. It's about a 2%, 2.5% to the downside to not own it underneath that $37 low, and about a 16% upside move. So once again, risk reward is very good. If the dollar does pull back, the emerging markets should see a resurgence here in the beginning of the year. So pay attention to the emerging markets. I wish you all a great and prosperous 2015, and you all take care.